Everybody, good afternoon. It is Fed Day. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here today with John Authers, columnist and author of The Fearful Rise of Markets. Also here today, Allison Schrager, our Bloomberg Opinion colleague, economist, and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We are waiting for the Fed decision in just about 5 minutes. It'll come out with a statement, but it'll be light on other details. No summary of economic projections today. The Bloomberg survey says overwhelmingly that the Fed will stay on hold here in a range of 4.25% to 4.5%. So it will be all about the messaging here. Exactly how much we should read into that messaging, I think it's sort of an open question. This is a data dependent Fed, and quite frankly, it feels like the economic data has been a bit hazy. The unemployment rate sort of settling in recently at 4.2% as of April. And of course, reported inflation has been relatively decent, 2.4% year on year on your headline CPI. Might even get further help on that headline number as energy prices have come in a little bit here. Allison Schrager, how should the Fed handle this fog of data and trade wars?
Probably do as little and say as little as possible,
Hmm.
which is what they're doing. Because
Say more.
honestly, because they don't really, it's not clear what they should do. I mean, even if we don't know how bad the tariffs are going to be yet, because we don't really know what they're going to be. We don't know how the economy is going to respond, and so I mean, it could result in higher inflation, in which case they're going to have to be more contractionary. Or if there is a big drop in growth, they're probably going to want to be more expansionary. Although that also leaves them in a tough position, because if there's a big contraction in growth because it's a supply shock, you kind of have to question the logic of trying to stoke demand, which is what the Fed does. So do you want to increase demand in response to contraction supply? That could increase prices further. So really, I'm just glad I don't work for the Fed and I'm not in this position. And if I were Jay Powell, I would just, be as tight-lipped as possible.
Yes, but you're a commentator for Bloomberg Opinion, and it's almost as important, Allison.
And so I have
John
opinions
Authers.
still. Yeah.
I would, if I were Jay Powell, I'd leave my options as wide open as possible. Yeah, there is no compelling reason to move rates in either direction now, because inflation is coming down, but it's still above target, and unemployment is still at the kind of level that doesn't demand any kind of action to ease. And there is so much uncertainty. It's far better to keep optionality and wait. And as you've been saying, there have been one or two other things that have been generally what the administration wanted anyway, whether the Fed wanted them or not. But cheaper oil definitely is no problem to anybody. The fact that the bond market is now behaving itself quite well after that one very scary week when bond yields rallied about 50 basis points in a week or whatever it was. They're back to normal now, and the weak dollar is not a problem for this administration. And in any case, it's not in free fall. As for the stock market, there's certainly no reason from macroprudential reasons to do anything for the sake of the stock market, because we're almost back to we've rallied back in very impressive fashion. There's nothing that requires the central bank to do anything.
Yeah. Well, speaking of markets, I've put up the yield on your 2-year note so you can follow along as the decision comes in. That's going to hit in just about 30 seconds, and we will bring it to you. Just for context, we go into this meeting with the futures market basically priced for 3 cuts this year. That would be potentially starting at the meeting after this, which will come at the end of July. Still plenty of time between now and then to take in developments, both on the policy front, but on the macro data front as well. So here it is. The Fed does hold 4.25% to 4.5%. No change there. We are seeing a tiny knee-jerk step down in the yield on the 2-year Treasury note as the decision passes, as the risk event passes, but hard to make too much of this. Let me just take you over to the headlines here for a second. Fed says the risks to both sides of its dual mandate have risen: price stability and full employment. Let's see. Fed says uncertainty about outlook has increased further. Let me just quickly take you through the strike-through version of the Fed's statement here, and I will actually give me bear with me for just a moment, and I'll put it up on screen so we can all work through this together. Here we go. Strike through. Okay. All right. So let's do this here. Share screen. Thank you, everyone, for your patience. Okay, so here's what we're dealing with here. Actually, you all probably can't see that terribly well either. Let's see if that helps. Okay, so May 7th, 2025. The statement now says, although swings in net exports have affected the data, we're talking about the GDP data, recent indicators suggest that economic activity has continued to expand at a solid pace. We can come back to that line in a bit. That's a juicy one to unpack. They go on to say the unemployment rate has stabilized at a low level in recent months and the labor market conditions remain solid. Inflation remains somewhat elevated. That is all exactly as the statement was previously. Then moving on, the committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. Uncertainty about the economic outlook has increased further. The committee is attentive to the risks to both sides of its dual mandate and judges that the risks of higher employment and higher inflation have risen. So let's stop right there. So they're saying that these are two-sided risks. Allison, you are an expert on risk. You sort of teed this up in the intro here. Is this exactly what you were expecting? Any surprises in this statement?
No, I mean, I guess the statement maybe was a little bit more positive than I anticipated, saying, highlighting that the economy does seem strong and resilient. So, I mean, I guess there's that, but yeah, I mean, it's pretty much what we expected, which is trying to keep optionality open. I support fewer dot plots. I'm sort of becoming anti-dot plot in general all the time. I think it's sort of again, they're definitely trying to keep their options open. They're definitely not going to commit because they don't know. They might need to cut. They might need to increase rates. I think Wall Street, I don't know if they're being optimistic or pessimistic when they're saying 3 rate cuts. I guess maybe they're anticipating a recession, although I read a good column yesterday saying that Wall Street wasn't pricing in a recession properly. So one of those, Wall Street really since for the last couple of years keeps pricing in rate cuts that don't happen. Do you remember? Was it like 2 years ago they thought we were going to get 6 rate cuts in 2024?
So hope springs eternal, I think is the phrase. Yes, yeah.
Although, is it because are they expecting a recession? Is this why we're going to get all these cuts? Or are they just hoping? I think they hope for normalization, maybe. And I haven't quite woken up to a higher R-star world that we're in. So
I find the implicit views. I mean, it's another columnist's desperate standby is when the bond market and the stock market appear to disagree with each other. When nothing terribly interesting is going on, you look for contrasts there. The stock market is working on the assumption that the tariffs are going away, more or less in their entirety. 3 cuts suggests the tariffs are staying and making a dent in activity. It seems to me there's really quite hard to read. The SARM rule has been triggered and then untriggered in recent months. In general, it's hard to read the data to suggest there are 5 more meetings this year, and they're going to cut in 3 of them. That's suggesting things are going to get very clearly worse.
Is it 4? Am I right that it's 4, John?
June.
It's the next one.
Definitely, we're priced to cut in most of the meetings between now and the end of the year.
Right.
Which, if you look at it that way, I guess if I had to, I so much is imponderably dependent on what the president decides to do with these ridiculous tariffs he's decided to announce, and how the rest of the world deals with him will affect that. But on the I myself would regard any situation where we need to cut that much that quickly as right near the worst end of what it's reasonable to fear at this moment. I can certainly imagine it, but I wouldn't make it my base case that I was pricing in the market.
So we do tend to fetishize the bond
by the way,
market.
I stand corrected. You were right. 5 more meetings here, John.
Okay.
Yeah. Go ahead, Allison. Sorry about that.
Yeah, I have noticed we always fetishize the bond market for being all-knowing. Like every time the yield curve inverts, we're like, oh, recession. Anyway, bond traders know as much as all of us. They're not like special. I mean, they're special to someone, but not. You can't see the future any better than the rest of us.
Yep.
But we said we do put an extra weight on the bond market. Maybe statistically, you would know, are they right more than everyone else?
The inverted yield curve, I think, has only been slightly less accurate than Claudia Sahm. Although Claudia Sahm, produced her rule after the event, kind of thing. It's one of the best recession indicators out there, but nothing is perfect. And certainly, if we escape without a recession this time, this will be by far the worst ding on the inverted yield curve as a recession indicator. It's never been as inverted as it was for this long without leading to a recession. And
it did call the 2020 recession before there was a pandemic.
Yes, that was impressive. Yes, that was.
Maybe they are special.
That was because Jeff Gundlach and Bill Gross knew about this virus going around the wet market in Wuhan or whatever, and started. Yes, believe that and you'll believe anything. But
incredible, incredible the market efficiency.
Yes,
extraordinary. Well, let me throw this one out there, right? We're living in a world of scenarios, I think, right? So it can be misleading to look at the futures market and say, well, they're pricing in 3 cuts. I guess 3 cuts is the base case. It seems more likely that either we're going to get none or maybe 1 cut, or things will really deteriorate and we'll get a lot of cuts. Do you think that's maybe actually what the bond market is telling us here? And this 3 is just sort of like what you get if you average out these 2 sort of extreme scenarios.
Well, it's a good way to look at this, I think, is the statistical concept of expected value. So, for example, if you toss a coin with 1 on one side and 2 on the other, then the expected value will be 1 times 0.5 and 2 times 0.5, which is actually an outcome that cannot possibly happen. If half the people think there'll be 1 cut and half think there'll be 5, then the expected value is 3 cuts, and nobody thinks that'll happen. I think that's plausible. Again, if there are that many people who see, I suppose you could say that it's that kind of a binary outcome. But I'm personally not that convinced that it is. I mean, I certainly think that this could end very, very badly indeed if if all the reciprocal tariffs, I hate to use that word, but if because they're not reciprocal, but if all the reciprocal tariffs do indeed go ahead as planned on July 8th, then I would agree with you. I would think 5 rate cuts would be pretty necessary to limit the damage, but I'm not sure I believe that's going to happen.
Yeah. Well, let's take a step back.
I mean, it doesn't seem monetary policy as tools really adequate to do a lot about, a trade war.
Exactly. Yeah.
You
It's
can
a
ask
tool you've
every-
got, but it doesn't mean it's going to be of any use. It's the can opener that you've got lying on your desert island. It's if there aren't any cans.
Right. But I mean, in fairness, it seems like this Fed would probably be cutting if we were not sitting here talking about the trade war, right? So the Bank of England is teed up to cut seemingly the ECB has been cutting. The Bank of Canada has been cutting. The backward-looking inflation statistics are actually pretty decent. So it does seem like, 3 or 4 cuts would be perfectly reasonable to be talking about, if not for these looming questions about the trade war and what they might do to inflation expectations. Would you take the other side of that, Allison?
Well, I mean, I think markets participants always have quite a lot of cognitive dissonance going on. So yeah, I mean, I watch Bloomberg TV all day, and you do hear these very cheery sounding people talking about the 3 rate cuts. So I guess they're thinking maybe tariffs will go away and the Fed will continue on its path towards normalization very quickly. Is maybe, I don't know if that's a sensible story, but I believe that people believe it because I think they always sort of see the best of things, and there is a story in that rate cuts do go with not that many that quickly, do go with a booming economy because it's a path towards normalization, right? Like we've looked at inflation, interest rates are arguably contractionarily high still, so they have to normalize. So, I mean, I don't know if that's a credible story, but I guess that is a story people could be telling themselves as to why we're going to have all these rate cuts, but also aren't pricing in any sort of like dire economic conditions otherwise.
Right.
I think I'd like to add to that just from what you were saying earlier, Jonathan. The reason, I regret to tell you that part of the reason the Bank of England is much more likely to cut than the Fed is because the British economy is in much worse shape than the American. But also there is a difference in the effect of the tariffs on different countries, in that for everybody else, assuming they're not retaliating one for one, they're straightforwardly deflationary. They will find it harder to sell stuff to the US, and that will inhibit their economy. And therefore you don't have this dilemma that the Fed has. Basically, if you think the tariffs are happening, you cut, if you're the Bank of England or the ECB. In this country, that's not so clear because the tariffs would appear on the face of it both to inhibit economic activity, but also to raise the price level. They give a justification for going in either direction. So personally, I'm not sure. I think when they made their first jumbo cut in September, they probably expected to be cutting more than just 3 meetings in a row. So I guess you're right. We probably would have cut, but I think we probably wouldn't be cutting this meeting. We would have cut in the last 1 or 2 and would have stopped by now at a slightly lower level than the rate at which we have stopped.
Yeah. Well, let me ask you this. You, John, brought up the cognitive dissonance between the stock market and the bond market. And, we're all kind of talking like some tariff doomers here, like some bond market people. And, some would say, like, hey, we're going to start talks with China this week. Talks are apparently advancing with Japan and India. The S&P 500 has recovered just about all of its losses since April 2nd, the so-called Liberation Day. maybe like, yeah, tariffs are high right now, but maybe we're all just being too much of doomers and missing the signal here. What do you think about that, John?
Well, first of all, while I certainly agree that the bond market isn't perfect and isn't clairvoyant, if I have to choose between the bond market and the stock market, I'm more likely to trust the bond market on what it says about the direction of the economy than the stock market. The issue that I have most, and it's quite difficult to make this point without calling without appearing to make a political point, but it's very difficult for many people to many of other countries to offer much in trade negotiations, because in fact they're not doing anything bad. They're not putting up any barriers against the US of any significance in the first place. And it's difficult to see what you can have some kind of a deal that means the threat of tariffs is removed again. I don't, with the huge exception of China and the smaller exceptions of one or two of the other, Vietnam being the most obvious example of one or two of the other countries that might be gaining some unfair advantages in trade, but Canada, Mexico, Europe, the great swathe of the countries with which the US does business and where there are possibilities of trade deals in the next few weeks. I mean, they're going to be trade deals that nobody would even notice, frankly, if there hadn't been so much fuss in the first place. They would be the kind of things that get thrashed out at the WTO over years, and only a few really serious trade nerds notice. So I everything depends on China, and the game theory on China still makes me think that either Trump has to very obviously cave, or we're going to have a really bad outcome.
So I'll take
that's my negative view of it.
I'm not going to defend tariffs, which no one hates more than me. But taking a rosier view, one, Pete Navarro not going to China. We just learned that today. Good sign. Also, I mean, I'm starting to feel like the more trade-friendly people in the administration seem to be having more sway. So let's just give us the best case scenario we could possibly imagine right now, which is 10% tariffs on everyone, maybe 60% on China. Still really high, way higher than like for a country like America, obscenely high. But, we don't trade that much. It won't be good. They'll probably shave half a point, 50 basis points off GDP, maybe one. Not good, but it's a tax. We have taxes. We have some bad taxes. It's not a good tax. So, and maybe we'll get a little boost from other things. I was just reading Dr. Doom, Nouriel Roubini, just said the economy is strong enough to take this. So maybe we'll just sort of have lackluster growth, but not a recession. And maybe, it is suggested that the bond market does have its own cognitive dissonance, because if we really expected a really hardcore trade war, I'd expect much higher inflation. Why isn't that in the 20 and 30 year? So you'd expect the yields on the long end to go up even more than they are.
Right.
No,
well,
the bond market, there was that 1 week, the week after Liberation Day, when the bond markets did I've heard all kinds of technical explanations for what did happen that week, but there were a few days when it looked like the bond market might be doing a serious revolt of the kind that Alison was talking about, and then it snapped back into behaving completely normally. Take away that week, and the bond market is not doing anything particularly alarming or particularly interesting in the last few months.
That's right. I think there are some sort of middle grounds between these two. I mean, it's possible, even probable, that there's going to be some de-escalation, but the question is, can you de-escalate and return certainty to economic actors and markets soon enough? That's one, right? We know that neither the Trump administration nor Beijing are just going to roll over, right? Two very prideful governments, let's say. And additionally, there are questions about where the economy sort of was when we got into all of this. I mean, we know that GDP was growing very strongly. We know that, an unemployment rate in the fours is in the low fours, I should say, is historically very, very good. But there have been many people who have made the argument convincingly, I think, that this economy was more brittle than maybe meets the eye, even before the Trump administration got in there, right? And you could, in the labor market, you could point to the fact that, well, not too many people were getting fired, but nobody was getting hired either. GDP in the first quarter, just sort of circling back to the Fed's statement, actually did contract, and now a lot of that is related, we think, to the tariff front running in the GDP accounting that ends up dragging down the number, not because tariffs are a negative on GDP, but because of the way the accounting works. And there's a hypothesis that inventories were actually undercounted in the first quarter. But all this is to say there is a case that this economy wasn't all that going into this. And I wonder what you make of that argument, guys.
Well, sorry, go on. Listen.
No, go ahead.
Okay, the ultimate soft data on the state of the economy was last year's election. It's very obvious that a lot of people in this country perceive the economy to be worse than the hard data says it is. And similarly, the soft data, I mean, it's very amusing but now that Michigan breaks down its inflation expectations and confidence by partisan ID, it is very funny indeed to see the lines on that chart disappear. Like I think the average Republican is expecting minus 0.1% inflation over the next 12 months, and the average Democrat is expecting 7% inflation, something really ridiculous and polarized like that. But the result of the election does, plainly told us something. People felt very unhappy about the economy. That does seem to be a fact, which most of the soft data bear out, and the hard data don't.
Yeah, I think people really hate inflation and didn't recover from the upsetting part of, especially when inflation hadn't been around for a while. I have the equivalent of taxi cab reporting from my lunch break yesterday about the state of the economy. I went to a department store on my lunch break and it was completely empty. And the saleswoman said that it has been bad the last couple of weeks and much slower than normal. So, I mean, I don't know. We're not seeing that. I don't think we're seeing it quite yet in consumer spending, but anecdotally, Saks Fifth Avenue in New York, totally empty.
All right. Well, so let's look ahead here, because it may be the case. It often is that the big news of the day actually comes from Chair Powell's remarks. In about 7 minutes here, he is going to deliver remarks, and he will take questions for about an hour or so from the media. And there's going to be a lot of parsing of what he says. We'll go into a lot greater detail than what we get from this statement. John Authers, what are you listening for from Chair Powell here? And is there anything that you could hear from him that might push markets durably in one direction or the other over the next few days or weeks?
I think not much point my trying to make predictions less than 10 minutes before it happens. That there has certainly been a marked tendency for.
Well, the point of you doing it is so that I can make fun of you if you're
exactly.
wrong.
Generally, there's been a tendency for the markets to assume he said something really dovish, often more dovish than he meant it to be. That's happened more often than not in the FOMCs over the last year or two. And so I imagine they will be waiting to jump on a moment of weakness and go with that. The more he talks about tariffs as being an inflationary issue, and or the more conversely that he says tariffs aren't, that goes with the argument that they're just a one-off increase to the price level and aren't inflationary. I guess that is the single most important measure in there that people will be looking out for, because we're all of us, fascinated by tariffs. If he surprises us all by being much more positive or negative about the market, about the economy rather, that will have its own impact. I suppose he could get into longer term discussion about the anti-inflationary framework, which is coming up for its 5-year review. They moved to average inflation targeting just in time for inflation to take off far higher than they wanted it to. I guess if he said anything substantive about that could have an impact. But my best guess is that he would not say anything substantive about that. I think he's going to try to avoid making any news of any kind.
Allison, what are you looking for when Jay takes to the podium, aside from the color of his tie?
Well, if I were him, I'm not sure I'm going to get this, but after Donald Trump has now said he's not going to fire him, but will probably replace him, I would just go like full on reiterating Fed independence and be like, I will not be bullied into doing anything. Like, if the economy weakens, it might not be appropriate for me to cut rates, and I still won't. So I think the best thing, the thing that the US economy, no matter what happens in the next couple of years, has going for it is Fed independence. And that, so I would just really reiterate that.
All right, fair enough. Well, I'll tell you, for me personally, I'd like to hear Jay just be straight with markets and the American people and tell us that he doesn't know what's going to happen here. I think that this is a central bank that is trying to figure out where policy goes. I think from a macroeconomic standpoint, policy is very, very important here. And I think they are right to be data dependent in a circumstance like this, and there's going to be a tendency for the markets to overreact in one direction or the other. We have we all have these natural language processors now that score Fed remarks as hawkish or dovish. But I think he should, and he probably will, do his best to strike a balance and say, look, it's an uncertain environment. I'm not trying to lead you in one direction or the other. We have a couple minutes before we wrap here. One final question I want to pose to both of you. As a lot of people see it, and I think as many Fed participants see it, the key risk here from an inflation standpoint is that inflation expectations, our inflationary psychology, becomes de-anchored, because in theory you're supposed to look through a supply shock like tariffs. You're supposed to kind of I don't know about it, ignore it, but look past it or whatever. But the question here is, we've been living with inflation for some time. We want to be very careful about our inflationary psychology. On the other hand, oil prices have been coming down sharply. Pump prices are down a bit. They might come down further. Does that offset your concern about inflationary psychology, John Authers?
Okay. Certainly over time, there are some technical reasons for this, but certainly over time, medium term or even quite long term, 10-year inflation expectations and break-evens are ridiculously correlated with the price of crude, which is quite comical in some ways, because if the oil price is higher now, it's more likely to be lower and less likely to inflate over the next 10 years. So if anything, there should be a very slight inverse correlation between them. That said, I think that might help the general psychology of people when it comes to continuing to spend. I don't know enough about the economics of refining and gasoline. It hasn't come through at the pump much yet. Not as somebody who does a lot of driving, but it hasn't really affected the gas that people put into their tanks yet. as for expectations in general, there was a very interesting paper which Alison will probably remember more chapter and verse of than I. It came in about 3 or 4 years ago out of the research department at the Fed, asking whether expectations mattered, and coming up with quite a good argument that perhaps they didn't. And there is an interesting argument to be had there whether they really drive inflation as some models have it. I certainly do think, though, as a general impressionistic rule, people are much more attuned to the risk of inflation now and much more worried about it, which makes this a dangerous time to stoke those flames with tariffs, with the possibility of a rise in the level. I certainly think that's one of many reasons why this is a dangerous gambit to be making right now. So I would be careful about it. I'm not sure I answered your question, but that's my best.
Hey, you know what? I'm going to leave it right there because I know that folks are going to be drifting over to listen to the Powell press conference. Thank you very much for that answer on this interesting talking point, actually from Neil Dutta of RenMac. I want to thank everybody for tuning in. Thank you very much, Alison Schrager. Thank you very much, John Authers, and we'll be back to talk about CPI. Thank you so much, and enjoy the press conference.